A major market shock is coming, and Wall Street isn't ready for it. The media isn't talking about it. Most investors don't see it. And that's exactly what makes it so dangerous. Because this time, the threat isn't coming from just one direction. It's building from two completely different fronts at the same time. Slowly, quietly, and then all at once. The cracks are already starting to show beneath the surface, but the market is still acting like everything is fine, like nothing is about to break. And that disconnect between reality and price is where the biggest opportunities are born. My name is David. That background taught me something most. Investors never fully understand. Markets don't crash when everyone expects them to. They crash when the pressure builds silently and then releases all at once. That's exactly the kind of setup we're looking at right now. And if you understand what's happening early, this isn't something to fear. It's something to prepare for. Right now, the market is fighting a war on two fronts. The first one is visible, but still underestimated. Global energy supply chains are under serious pressure, and one of the most critical choke points in the world is at the center of it. When a major route that handles a significant portion of global energy flow gets disrupted, the effects don't just stay in the oil market, they ripple outward into everything. Transportation costs go up, manufacturing costs increase, supply chains slow down, and suddenly every company in the market is dealing with tighter margins. That's how inflation creeps back in even when central banks think they've controlled it. And the scary part is, these effects don't show up immediately in stock prices. There's always a delay. Businesses keep running on existing inventory. Contracts stay locked in for a while, and everything looks stable. Until it isn't. Once those buffers run out, the impact hits fast. Prices adjust, expectations reset, and markets react violently. Now here's where it gets even more serious. Some of the most important industries in the world depend heavily on stable energy supply, and one of the biggest is semiconductor manufacturing. Advanced chip production isn't just about technology. It's about resources, massive amounts of energy, rare materials, and extremely delicate supply chains all have to work perfectly together. If even one piece gets disrupted, the entire system slows down. And right now, that system is under pressure. Certain regions that dominate chip production rely heavily on imported energy. If those suppliers get squeezed for long enough, production doesn't just become more expensive, it starts to slow down. And when chip production slows, it doesn't just affect one company or one sector. It affects everything, from smartphones and laptops to data centers and artificial intelligence infrastructure. This is the backbone of the modern economy, and it's more fragile than most people realize. But that's only the first front. The second shock building in the market is far less obvious, and that's why it's even more dangerous. It's happening inside the AI industry, the very sector that has been driving most of the market's growth and excitement. Over the past few years, artificial intelligence has become the center of investor attention. Billions and billions of dollars have been poured into building infrastructure, training models, and scaling systems faster than ever before. Companies have made massive commitments, betting on future growth that hasn't fully materialized yet. And as long as everything keeps growing smoothly, that's fine. But when expectations get too far ahead of reality, even a small crack can cause a huge shift in sentiment. Right now, there are signs that not everything is going as perfectly as the market believes. Growth expectations are extremely high, spending commitments are massive, and competition is intensifying. When companies promise enormous future expansion, they are locking themselves into paths that require everything to go right. But markets don't work like that. There are always setbacks, delays, and unexpected challenges. And when those challenges start to appear, investors suddenly realize that the future they priced in might have been too optimistic. That's when valuations compress. That's when momentum slows. And that's when the same stocks that led the market up can start pulling it down. So now you have two forces building at the same time. On one side, you have supply side pressure increasing costs and squeezing margins across industries. On the other side, you have demand side uncertainty inside the very sector that has been holding the market up. And when those two forces hit together, they don't just add up, they amplify each other. Higher costs reduce profits, weaker expectations reduce valuations, and suddenly the entire market has to reprice risk all at once. That's how sharp corrections happen, not because of one single event, but because multiple pressures converge at the same time. And here's the most important part. The market still isn't fully pricing this in. Prices remain elevated, sentiment is still relatively optimistic, and most investors are still focused on short-term momentum instead of long-term risk. That's exactly the kind of environment where smart investors start, preparing quietly while everyone else is still comfortable. Because when the shift finally happens, it happens fast. There's no warning bell, no clear signal that says, now it's time. By the time the headlines catch up, the move has already started. But this isn't about panic. This isn't about selling everything and running away from the market. That's not how real money is made. The biggest gains don't come from avoiding crashes. They come from being ready for them. Every major market correction in history has created massive opportunities for investors who were prepared. The key is understanding the difference between short-term noise and long-term value. When prices drop because of fear, not because of permanent damage to a business, that's when opportunities appear. Think about how markets have behaved historically. Bull markets last longer and create far more wealth than bear markets destroy. Corrections feel intense in the moment, but they are temporary phases in a much larger cycle. The investors who succeed over time aren't the ones who try to predict every move perfectly. They're the ones who stay patient, stay disciplined, and take advantage of moments when others are acting emotionally. Fear creates discounts, panic creates mispricing, and that's where long-term investors step in. Right now, we're approaching one of those potential turning points. The data is starting to shift, the underlying pressures are building, and sentiment hasn't fully adjusted yet. That gap between perception and reality is what you need to pay attention to, because once that gap closes, the opportunity starts disappearing. The best time to prepare is before the crowd reacts, not after. Smart investors don't chase everything. They focus. They build a watch list of high-quality companies, businesses that have strong fundamentals, solid cash flow, and the ability to adapt even in difficult conditions. They watch how those stocks move, how they react to news, how they behave during volatility, and then they wait. They don't rush in. They don't try to catch the exact bottom. They wait for the moment when fear takes over the market and prices disconnect from value. That's when they act, because at the end of the day, markets are driven by human behavior. Greed pushes prices to high, fear pushes them to low, and over time, everything moves back toward reality. If you can stay rational while others are emotional, you gain an edge that most people never develop. And in a setup like this, where two major forces are building at once, that edge becomes even more powerful. So don't focus on the noise. Focus on the structure. Understand what's happening beneath the surface. Watch how these two forces evolve over time. Because if they continue building the way they are right now, the market isn't just going to drift lower slowly. It's going to move sharply. And when it does, the investors who prepared early will be the ones in the best position to benefit from it. And that's exactly what we're going to talk about next. How to position yourself, what kind of companies to watch, and how to take advantage of one of the biggest opportunities this market might offer in the coming months. Now the question becomes, what do you actually do with this information? Because knowing that a market shock is coming is one thing, but positioning yourself to benefit from it is something completely different. This is where most investors get it wrong. They either panic too early and miss the upside, or they react too late and absorb the downside. The goal is not to predict the exact moment the market turns. The goal is to be prepared before it does. That means thinking differently than the crowd, acting based on data instead of emotion, and understanding that volatility is not your enemy. It's your opportunity. When markets become unstable, the gap between price and value widens, and that's where disciplined investors make their biggest moves. The first thing you need to understand is that not all companies are affected equally. During market stress, some businesses get crushed because they rely heavily on cheap capital, weak margins, or unstable demand. Others become even stronger because they have pricing power, strong balance sheets, and products that people can't easily replace. That's where your focus should be. In a market like this, you don't want average companies. You want the strongest players in critical industries, the ones that can raise prices when costs go up, the ones that can survive disruptions while their competitors struggle, and the ones that come out of downturns with even more market share than before. Think about industries that sit at the center of everything right now: technology infrastructure, semiconductors, cloud computing, and artificial intelligence. These are not short-term trends. These are long-term structural shifts that are still in their early stages. Even if the market pulls back, the demand for these technologies doesn't disappear. It slows temporarily, adjusts, and then continues growing. That's the difference between hype and real transformation. And when you combine long-term demand with short-term fear, you get some of the best investment setups possible. Now let's break this down into a simple strategy that actually works. Instead of trying to watch every stock in the market, you narrow your focus to a small group of high-quality companies. These are businesses with strong fundamentals, dominant positions in their industries, and clear long-term growth drivers. You study them. You understand how they make money, what risks they face, and how they behave during volatility. And most importantly, you decide in advance at what prices they become attractive to you. This is critical because when the market starts dropping, emotions take over. Prices move fast, headlines get worse, and it becomes very difficult to think clearly in the moment. But if you've already done your homework, you don't need to think. You just execute your plan. Another important piece of this strategy is patience. Opportunities like this don't appear and disappear in a single day. Even though market drops can feel sudden, the process of forming a bottom usually takes time. There are multiple waves of selling, temporary rebounds, and periods of uncertainty. That's why experienced investors don't go all in at once. They build positions gradually. They scale in as prices become more attractive. This reduces risk and allows them to take advantage of further declines if they happen. It also removes the pressure of trying to time the exact bottom, which is something almost no one can do consistently. At the same time, you need to manage your expectations. Not every drop is an opportunity, and not every opportunity works immediately. Markets can stay irrational longer than most people expect. Prices can go low, even when fundamentals remain strong. That's part of the process. The key is to focus on the long-term trajectory instead of short-term fluctuations. If the underlying business is solid and the long-term trend is intact, temporary volatility becomes noise rather than a threat. Another tool that can help you navigate this environment is sentiment analysis. Markets are driven not just by fundamentals, but by how people feel about those fundamentals. When investors become extremely optimistic, they tend to overpay. When they become extremely fearful, they tend to undersell. This creates cycles of overvaluation and undervaluation that repeat over time. By paying attention to sentiment indicators, you can get a sense of where the market stands in that cycle. When fear starts rising sharply and panic begins to spread, that's usually when the best opportunities start appearing. Not because the situation is comfortable, but because prices are reflecting worst-case scenarios that often don't fully materialize. Right now, we are in a transition phase. Optimism is still present, but cracks are forming. Data is starting to weaken in certain areas, risks are building, and uncertainty is increasing. This is not the time to be careless, but it's also not the time to be completely defensive. It's the time to prepare, to build your watch list, to increase your awareness, to make sure you have the flexibility to act when the moment comes. Because once the shift accelerates, you won't have the luxury of time to figure everything out. Let's also talk about something that often gets ignored during times like this: liquidity. In simple terms, liquidity is your ability to take advantage of opportunities when they appear. If all your capital is already invested and the market drops, you might recognize great deals, but have no way to act on them. That's why experienced investors always keep some level of flexibility, not because they're afraid, but because they understand that opportunities require resources. Having cash or available capital during a downturn is like having ammunition in a battle where everyone else is running out. It gives you options, and in investing, options are incredibly valuable. Another important mindset shift is understanding that downturns are not permanent. Every major correction in history has eventually been followed by recovery and growth. The timing may vary, the path may be different, but the long-term trend of markets has always been upward. This doesn't mean every company survives or every investment works out, but it does mean that the system as a whole continues to evolve and expand. By aligning yourself with that long-term trend, you reduce the impact of short-term uncertainty. What separates successful investors from the rest is not intelligence or access to information. It's discipline. It's the ability to stick to a plan when emotions are high. It's the willingness to act when opportunities are uncomfortable. And it's the patience to wait when there's nothing worth doing. These are simple ideas, but they are incredibly difficult to execute consistently. That's why so few people achieve long-term success in the market, even though the principles themselves are not complicated. So as this potential double shock continues to develop, don't get caught up in predictions or headlines. Focus on what you can control: your research, your preparation, your strategy, and your behavior. Build your list of high-quality companies. Decide your entry points. Keep some flexibility in your portfolio. And most importantly, stay patient. Because when the market finally reacts to these pressures, it won't be subtle. It will be sharp, emotional, and filled with uncertainty. And that's exactly when the best opportunities appear. At the end of the day, this is not about reacting to fear. It's about using fear. It's about recognizing that the same forces that create panic in the market also create possibilities for those who are ready. The investors who succeed are not the ones who avoid volatility. They are the ones who understand it, prepare for it, and take advantage of it when it arrives. A major market shift is building. It's not fully visible yet, but the signals are there. Two powerful forces are moving toward each other, and when they collide, the impact will be felt across the entire market. Most people will only realize what happened after the fact, but you're seeing it early. You understand the setup, and that gives you an edge. Now the only thing left is what you choose to do with it. Because in moments like this, the difference between average and extraordinary results comes down to one simple decision: whether you act with the crowd or ahead of it. And if you've made it this far, you already know which side you want to be on. This is David, and remember, the best investment you can ever make is in your ability to think differently.